Hello everyone. I hope you all are doing great and enjoying the class so far. In this chapter, we'll talk about the domestic and international financial marketplace. So, we will try to understand broadly how the financial markets look like and what is the motivation behind establishment of those financial markets. Or if I say it differently, we'll try to understand the role of different aspects of financial market. Then we will try to understand the structure of financial markets in the United States as well as the financial markets internationally. Or what does it take to get involved in international investing activities? Uh, what is the, of course, whenever an investor involves in international investing activities, the investor gets the benefit of diversity, international diversification. Not diversity, I'm sorry. The investor will get the benefit of international diversification. But the benefit of international diversification comes with some kind of cost, and that cost is in terms of additional risk that an investor has to take. We will just very little bit, we will touch upon that kind of risk very little bit, and then some of the instruments which are available to hedge that risk. We'll talk a little bit about those kind of instruments as well. So in order to understand all that, we will have to understand the currency market in the global economy. Like if you're talking about international investment, then you need to understand those international level financial, not only you need to understand those international level financial organization, but also the international currencies, what the exchange rate is, how do you read that exchange rate, how can that exchange rate fluctuate, those exchange rate fluctuations affect your return on investment. So those are the things. Of course, international finance is a subject which is completely devoted to all this, but here also I will touch upon a little bit on those things. Then we'll talk about market efficiency, different forms of market efficiency as well, and why is it relevant to understand market efficiency? What are the implications of market efficiency concept to what we are studying here? And then we'll talk about holding period return, how to calculate those holding period returns, and at the very end we'll also talk about the financial crisis of 2007 and 2008. Like we'll try to understand how did that financial crisis, how did that initiate, and what kind, how it kept on booming and affecting the economy, not only the US economy, but the economies all over the world. So this is the broad agenda of the chapter, the domestic and international financial marketplace. Okay. So the first thing here is I want you to understand the financial system. First, we'll try to understand the US financial system. So financial system, I should say, is the backbone of any economy. A sound financial system can help rise an economy, whereas if the financial system of the country is lame, the economy can never rise. So why is that so? What does the financial system do to the economy? Okay, so that's the first question that comes to our mind. What is this financial system doing to the economy? I mean, we are not if we are talking about only the financial markets, those financial markets per se directly are not involved in any kind of manufacturing activities or something like that. I mean, it is the flow of money from here to there, right? There is no, the money is not producing anything as such over there. But this flow of money is extremely important. First, we'll try to understand how this flow takes place. Now see, for any financial system to get succeed, whatever savings or whatever surplus funds one group has, those surplus funds should not remain idle. Those surplus funds should be invested in some kind of productive activities. Okay, and now which surplus funds I'm talking about? Just take the example of your own home, your own family. Your dad earns, your mom is earning, and they both are earning, and some part of their income which they are not spending on a monthly basis, they are saving, right? Now, if they will keep those savings inside the house and they will keep piling up those savings, the value of that money over time decreases. You see, currently what the inflation rate in the United States is, it is 6% annual inflation rate, which is a huge number, which is a big number. That 6% inflation rate means if you could buy a laptop worth of $1,000 a year ago, today you will get the same laptop for $1,060. If your grocery bill was $500, let's say per month, 1 year ago, today the same grocery bill has increased to $530. I mean, I am not talking about one specific item. I'm just talking about overall inflation. Okay, so because of inflation, what is happening? The value of money is decreasing. In order to get the same basket of goods, like the same grocery shopping requires you to have more US dollars. Earlier you needed just $500, whereas today you need $530. That means what? That means inflation has reduced the value of money. So if your mom and dad, whatever they are saving, if they will keep that aside inside the house, what would happen going forward? Because of inflation, the value of that money keep on decreasing. They are not getting anything out of it. Now they have another option. They can invest that money. Let's say they deposit the money in a saving account. The saving account is giving them some interest. Okay. And so because of that interest, their money will keep on increasing, right? And now, if they have deposited their surplus money in bank, what the bank is going to do with that money? Bank will provide loan to some of the firms who need money to invest that or to grow their company further. They want to, let's say, buy a new machine, but they don't have money. What are they going to do? They will approach the bank. Bank will provide them loan. They will buy the machine and they will start those productive activities, right? Now, where from the bank is going to get the money? The bank will pool the money which is being provided by those households. Okay, so they will provide that money to the bank. Bank will pool it together and give this money in the form of loans to the required to the people or to the firms or to the corporations who need that money. Now, why is bank doing all that? Is bank doing any kind of social service? No. Bank is also making money based on the spread, like the interest that the bank pays to its customers on saving is less than the interest that the bank charges on any loan that it provides. So that difference in interest is bank's income. So bank is also making income and making it possible for the surplus funds to go to the deficit units, and those funds now are becoming productive. More efficient the financial system of a country is, better this whole process will work. So basically, what I just explained, it was the simplest example. I just used bank as an intermediary, or a financial institution which intermediates between the savers of the funds and net users of the funds. Okay. Uh, Financial markets are there, like stock exchanges and all that. They are also facilitating the same kind of activity. So that is basically how the overall system of the overall financial system works. That one group of people, or one unit has some surplus funds. There is a group of intermediaries. They collect all those surplus funds, pool them together, and they provide those funds to those deficit units who needs funds, who are in deficit currently and who needs funds. And then definitely that production or those kind of activities take place. That's how the financial system of any country, any economy works. Okay. Now this is exactly what I just explained. This is just the same diagram. Overall, in the United States, these households, they are the net, they are basically considered as the surplus units, and the business houses, they are generally considered as the deficit units. Okay. So what is happening? Now funds are going from these surplus spending units, the ultimate lenders, like which are in our example, which are households. The funds will go to the financial middleman, like brokers, dealers, or investment bankers, or the banks. The funds are going there, and from there, sorry, these are the financial middlemen, not the intermediaries. In this particular diagram, intermediaries are mentioned separately. So these middlemen, like the brokers or dealers, they through brokers and dealers, we do the trading in the stock market. We invest our money through dealers or brokers and in the financial markets. So the funds from there are going to those deficit units, who are the ultimate borrowers, the business houses. Okay. And this same way, the funds can go in. If somebody is not directly investing in those stock markets, they can deposit their money with any of these financial intermediaries, like commercial banks. The example that I just used was from commercial banks. We also take insurance policies, life insurance policy. We deposit, or we invest some of the one part of our income for some pension funds, like that 401 k and all those kind of schemes. They are for pension funds. So the employer, they deduct a certain portion of their employees' salary towards their pension. They deposit some amount to that and club that amount together and establish a pension fund and invest from there. So that is also kind of going from our pocket, and that money is also pooled together, and that money is then invested elsewhere. Okay. So that's how it works. Okay. So now in the United States, what are the major financial assets that we talk about? Money is definitely a financial asset. Apart from money, debt securities and equity securities, they are also considered as, they are also the financial assets. In case of debt securities, you do not get the ownership, rather you are the lenders. Being a lender, you get fixed interest rate and repayment of your funds after a certain time period. Your principal amount is repaid after a certain time period. Debt securities, they have a lifetime. Then equity securities, these securities provide you the shares that we buy. So these securities provide you the ownership. So you become the owner. You get a claim by buying those equity securities. You are basically getting a claim in the on the assets of that business, on the profits of that business. So whatever that business is gonna make, you will have a claim on that. Okay, so that's why you get dividends. If you are the owners of equity securities, you get dividend. Dividend is the distribution, nothing but the distribution of profits. Okay, and then when we talk about financial markets based on the maturity of those financial claims or financial assets, financial markets can be categorized as money market or capital market. Money market deals with short-term securities, whereas capital markets deal with long-term securities. So based on the maturity of those securities, the markets are classified as either money market or the capital markets. Okay. The other classification for financial markets is primary and secondary markets. A market is said to be primary market if the securities are traded for the first time. Excuse me. And whatever money is collected from by issuing those securities, the firm is getting that money directly. So in a sense, you can say that it provides you a direct link between the firm who is actually getting those funds and the investor. In case of secondary markets, the stock exchanges around us, NYSE, NASDAQ, these are secondary markets. The securities which are already issued, they are traded in these markets. So sound secondary markets, trustworthy secondary markets are really important, because even the transactions which are taking place in the primary market, the trust comes from secondary markets. Now I will tell you why. Okay, so just imagine there is a new firm which is getting started. The firm issues shares. Okay, so you have some surplus money, you want to invest your money. Somebody tells you, or you get to know that, oh, so and so firm is issuing new shares, why don't you go ahead and just buy those shares? Now if you buy those shares, basically the firm will never repay. If those are equity shares, okay, the firm is never ever bound to repay the money till the time it exists. And if you remember in the in the first video, I mentioned that these corporations have perpetual succession. These corporations have like indefinite life. Members may come, members may go, but the firms go on forever, and their life is like 500 years. Man, I do not want my funds to stuck with that company for 500 years. I do not want to wait for 500 years to get my money back from there. That this firm, oh, I don't know, after 500 years, and who knows, even after 500 years, the firm will close. I don't know, right? So the firms can go on forever. You just do not know. They have indefinite life. So I'm not gonna wait indefinitely to get my money back. So I need to find a way that whenever I need my money, I can just cash it out. Right now I have surplus funds. Who knows, like 5 years from now, my daughter is gonna go to the college. So whatever I saved today, I would like to get that money at that time when my daughter would like to go to the college. I need to pay for her college fee, right? So if I cannot get my money back, I'm not going to invest there. I would rather keep that money under my pillow. No, I'm not going to invest it. Now, here comes the role of these secondary markets. Okay, these secondary markets, they provide us the trust. They provide liquidity to the securities. Liquidity means ability to convert your securities into cash without substantial decrease in the prices. Okay, in the share market, if you own some shares, you can sell them in within few seconds. You can just sell your shares in the secondary market at the existing price, whatever price at that time is. Okay, and more efficiently this process can be done. More trust people will have, and if they have trust, they will never hesitate to invest in any firm, be it the IPO, if they want to buy the shares of a new firm or buy new shares, they won't hesitate because they know they can cash them out whenever they want because of those efficient secondary markets around us. Okay, so primary markets are those markets where the securities are traded for the first time. The new issue market, it is also called new issue market because the new securities are traded in that market. And here, in case of in primary markets, there is a direct link between the investor and the firm, because whatever the investor is paying, firm is getting that money. Whereas once these securities are issued, afterwards, these securities will always be traded through the secondary market. Now, the firm doesn't have any connection with it. The firm doesn't have anything to do with it. Now, the securities would be traded in the secondary market. One investor, those shares are simply changing hands amongst the investors. Firm has already got whatever it was supposed to get. Okay. Then there are some financial intermediaries. I mean, it is something probably you have already studied a lot. It's all about there are commercial banks which pool the saving of people together and then loan that money, and in between they earn that the spread. Thrift institutions, investment companies, pension fund. I mean, you know about all of them. It's quite simple. I wouldn't like to spend a lot of time on that. You can read that on your own. It's very simple thing, nothing to explain about them. So then what is the structure and operations of the US security markets? Okay, the stock exchanges. So there are security exchanges and some stock market indexes. Now I'll talk about what they are. So whatever securities, as in the previous last to last slide, I was talking about that in the primary markets, the securities are issued. Now those securities are traded. They change hands later on in some secondary market. So that secondary market is the stock exchange. So the firms have to list their securities with some stock exchange. Okay, whatever stock exchange those securities are listed on, they are traded on that stock exchange only. Okay, so the stock exchanges have their own criteria for listing. They list up the securities of any firm once the firm fulfills some criteria. Okay, so NYSE has some upper level criteria, like the with respect to the minimum amount of profits, the minimum market cap of the firm. So there is some kind of criteria. That is the reason why NYSE always deals with mid cap or large cap firms. Okay, those small firms, they are traded through NASDAQ because their standards are pretty comparatively low. And it is not necessary that the securities are listed only on the domestic stock exchange. NYSE, NASDAQ, they both are US stock exchanges. Okay, they are national level stock exchanges. Whereas in United States only there are a lot of even regional stock exchanges. And one firm can decide to cross-list their shares even on some other countries' stock exchanges. So that is also possible. They also do it. But generally for international securities, the standards are even higher than those domestic securities. So now how these stock exchanges function, they function either through brokers or market makers, designated market makers. So brokers, they are kind of the middleman. You place the orders through the brokers and they help you get your buy or sell your securities. The market makers, they are slightly different people. They are not simply the middlemen who are helping buying and selling, where they keep a chunk of securities with them, and they always post some bid prices, ask prices. And the prices that they post, they are always ready to buy or sell the securities at those prices. Okay, they have secure stocks with them and they post those prices. So bid price means the price at which market makers are ready to buy the securities. For you as an individual investor, this is the price at which you will be able to sell your securities. Okay, so these bid prices, ask prices, they are set up by market makers. Bid price is their buying price. And of course, in any buying and selling transaction, there are two parties involved. One buys, other one sells. If market makers are buying, the individual investors or the retail investors, they are selling those securities. Okay, ask price is their selling price, market maker's selling price. This is the price at which they are ready to supply the securities that you want to buy. Okay, and definitely ask price is always greater than the bid price, and the difference between ask price and bid price is called spread. These market makers, since they are taking a risk by holding those securities all the time and providing a market for those securities, they are always ready to buy the securities. They always have the securities which they are ready to sell. So by keeping the securities, they are taking some risk. And for that risk, they charge this spread. That's why they buy at a lower price. Their bid price is always lower than the ask price. So they buy at a lower price and sell at a higher price. The difference is called spread. Okay, so this spread depends on the liquidity also. If there is a great demand for those stocks, this spread is generally really low because market makers do not bear much of the risk in that case. They know people are always there, investors are always there who are ready to buy or sell these securities. So they will not have to face much of the difficulties. But for a firm whom people do not know much, investors do not know much, and they generally do not trade in those stocks. For such stocks, the spread is really high because the market makers are taking more risk for that. Okay. Now, the securities are traded in two different ways. One is like the floor trading, where like NYSE, it is a floor trading platform where the securities are traded. Other than that, there are OTC markets. Nasdaq is the example for over-the-counter markets. This OTC market, this is basically multiple market makers who are connected through a connection of like the internet, and there they are dealing, there they are trading. No specific floor for those kind of stock exchanges. Okay. Then we talk about market indexes. So different stock exchanges, whatever their securities are listed, so they pick a some top securities. Like for Dow Jones, it's different number of securities. For S&P 500, there are 500 such top firms. They pick them, they average them out, and they create an index based on those securities. They include those securities in these indexes, and that basically reflects the uh, overall stock market. Like you might be hearing about, like Dow Jones is down by these many points, it is up by that many points. So those points, that is basically the aggregate of price of those securities which are included in that particular index. Okay, and if most of them are going up, some of them are getting down a little bit, so overall the aggregate impact for that would be upwards. Okay, so then yeah, we will of course, we as retail investors, we do not know much about the company internally. Okay, and for us, as I told you, that more efficient those stock markets are, more trust we will have, and we will not get hesitant in supplying our surplus funds to those markets. Because if somebody can ensure us that yes, your funds are safe, your funds are secure with us, if somebody is there to ensure us about it, we will never be hesitant in supplying our funds to the market, right? So now, where that assurance come from? The assurance come from the regulation of those security markets. Okay, the security markets, these stock exchanges, they are regulated by SEC in the United States. For every country there is a regulatory body. Okay, there is a regulatory body for every country which basically keep a close watch on the stock exchanges, their functioning, the firms and all that. They keep a close watch, and it is to improve to save the interest of the common investors, so that the big giants, they cannot just ditch them. Okay, because what happens in the stock markets, one is earning at the cost of somebody else, because initially once the securities are sold, now they are bought and sold in the secondary market. Okay, if you are selling at a really low price, one is getting benefit because he could buy at a low price, but you will be at a loss because you are selling it at a low price. So one earns at the cost of others, and if that benefit always that benefit goes to the pocket of those giants, the small investors will get exploited every time. Okay, and it should not happen in an efficient system. It should not happen, right? So that is why these regulations are in place, so that those small investors' interests can be saved. Okay, there are some laws which have been passed time to time to save the interest of those retail investors, like Blue Sky Law. These laws were passed in 1911, well before even the Great Depression, which was in 1929. And these were regarding some of those risky securities. Then SEC came into existence after that Great Depression, like 1933. There was an act, and then it was amended in 1934. So since then, like, those regulatory bodies are in place, and the job of these bodies, like, every public firm has to submit their 10K statements, like the annual report of their firm, their 10Q statement, which are the quarterly report, as well as proxy statement. Proxy statement is issued well before any annual shareholders meeting, and this includes, like, what would be the topics which will be discussed and on which topics the voting will take place in that shareholders, like basically all the detailed agenda of that meeting. Okay, Then there are some insider trading laws as well. Insider trading means every firm has some insiders. Okay, insiders are like the management of that firm, the board of directors of that firm, who have more information than the outside investor. I do not know what is going on inside Apple, what their next strategy is going to be. I don't know what's going on inside Microsoft or IBM or Tesla. I don't know about their policies because I am just, I can know only something which is there on the news. I mean, only the information which the management decides to give, only that information is with me. Because if the management decides to give some information, that will come to the news, right? Otherwise, I don't know what's going on. If they are making some they have some future plans, future investment opportunities with them, I don't know, unless and until they will come out and just let me know about it, right? So by the time general investor is unaware, but insiders, they are still aware of it. And if, let's say, the insiders know that the firm is going to be bankrupt soon, okay, they have that information that, okay, they have all those financial statements are not public yet, not out yet, but before that they are actually responsible for preparing those financial statements, so they know about it, right? And since they know it, they can sell all the securities that they have because they know the firm is going to be declared as bankrupt very soon, right? So they will sell their shares. And who will buy those shares? The people who are the investors who are unaware of what's going on inside. So if such kind of activities get promoted, what happens? Common investor will lose trust. So there are some insider trading laws in place also. SEC keep a check on those tradings, and every insider has to give the complete details of the trading that they are doing, okay, in the stock of that firm, whether they are buying, selling, so that a close eye can be kept on that, and they are not able to cheat the retail investors. So all these regulations are for the efficiency of these stock markets. Okay. The Sarbanes-Oxley Act, it came into existence after whatever happened with Enron. Okay, so it was the result of this. Now, after the Sarbanes-Oxley Act was passed, um, uh, like there was a dot-com bubble in 2000s, right? So after that, this new act was passed, and according to this act, top management is held responsible for the accuracy of financial statements. Okay, top management cannot say that, oh no, we were not aware of it. They cannot just say and get away with it. They are responsible for it. This act strengthened and the independence of accountability, independence and accountability of the audit committee. Audit committee has to be independent, should consist of independent members. And it created the Public Company Accounting Standard Boards. It requires that the auditors now certify a firm's financial control system and ensures independence of the financial analyst. Like, they should not be the board members or something. They should be independent. They should not have any vested interest in that firm. Okay, so that's what independence means. Now, now let's talk about the multinational firms, or whatever we did till now. It was related to the US financial system. Okay. Now let's talk about the global economy and how those multinational enterprises they take place. So first thing is, what are those multinational? Multinational, as the name itself suggests, it means more than one nation is involved. Okay, and it can be involved in any sense. Maybe those firms are simply trading, like import and export. Maybe those firms establish their manufacturing units in other countries. Maybe they have subsidiaries in different countries. Maybe they have just the distribution channels in other countries. Whatever the way is, but somehow they generate revenues from a nation different from the domestic territories. Okay, so whatever the way is, but they generate some revenue from those from internationally. Okay, so a multinational corporation is like it can have direct it will have direct investment in manufacturing, and or just it can just be the distribution facility in more than one country. Okay, so goods and services, when they are bought from the international market, that is called import. When they are sold to the international market, that is called export. So the difference between import and export is considered as trade surplus or trade deficit. If we are importing the goods, that means what? Currency will be going out. If we are exporting, that means the currency is coming in. If our imports are greater than exports, that is called trade deficit. And if exports are greater than imports, that is called trade surplus. Okay, you are exporting more, so earning more of the currency rather than spending it. Okay, so that means you have a surplus. Okay, so now we will talk about exchange rate, what is euro currency market and all. Give me a minute. Okay, yeah. So first of all, like, what is exchange rate? The rate at which currency of one country can be exchanged with the currency of other country is called exchange rate. Okay, the rate at which currency of one country can be exchanged with the currency of the other country is called exchange rate. So let's talk about the exchange rate of US dollar with euro. I mean, the dollar value in terms of euro would be different than the dollar value in terms of pounds, or the dollar value in terms of Indian rupee, or the dollar value in terms of Japanese yen. Okay, so exchange rate is always in relative terms. US currencies exchange rate with pound sterling, or US currencies, which is like dollar, its exchange rate with Japanese yen, or US currencies exchange rate with euro. So it has to be always in a relative sense. Okay, in relative terms. That is exchange rate. Now I will show you how do we quote those exchange rates and all. Okay, so what is euro currency market? The euro currency, that is basically a generalized term for euro dollars or something. So euro currency here means the currency which is deposited in a bank located outside the country of its origin. Same euro currency would be considered as euro dollar if a US firm transfers these dollars from a bank in the United States to the bank which is outside the United States. So since the dollars are going outside the United States, they become euro dollars over there. LIBOR means London Interbank Offered Rate. This LIBOR rate, it is an interest rate. Basically, the first thing that you need to understand is LIBOR rate is interest rate. But interest rate with whom? Like who is borrowing, who is lending, which interest rate is that? So it is the interest rate at which the banks in euro currency market, they lend to each other. Okay, because one bank is giving money, depositing, like sending dollars to the other one. They also lend and borrow with each other. So that this rate is the interbank offered rate. Okay, so this is called LIBOR rate. Okay, now the euro, a common European currency. We all know that in Europe, like there are 11 countries in Europe, which all of them accept the same currency, which is called euro. It happened in on January 4th of 1999, when all these countries, they decided to have a common currency, so that there is no issue of exchange rate amongst those countries. The trade amongst those countries is easy, and it is easy to maintain the stability of currency. So those were the things. That's why all these countries, they decided to have a common currency. It was basically to boost the trade, to get rid of all those restrictions, trade restrictions, because the extreme fluctuations in exchange rate might lead to decrease in the foreign trading activities, right? Because foreign trading activities, they are not like, okay, today trade is taking place and the transaction is settled on the same day. Sometimes the transactions are settled like 3 months later, and by that time, if the exchange rate has changed already, then it adversely affects that international trade. Okay, so I mean, those European countries, they wanted amongst themselves to have a trust, and they don't hesitate to go for international trades. That's why they decided to have a common currency. Okay, and there is one single bank, central bank for all these countries, which is European Central Bank. All these European Union members, they decided to have that. For example, in United States, we have federal bank, right? In every country has its own central bank. But in case of European Union, they all have a common central bank, which makes the monetary policy for all those countries. Okay. Now, okay, how the foreign exchange rates are quoted. Now we'll talk about direct and indirect quotes, and I will show you how all that in another part of the video. It will be too long, so I am just stopping it here, and in the next video I will explain you like how these foreign exchange rates are quoted, and the remaining part of the chapter I'll discuss in the next video. All right, so have a great time for the time being, and see you in the next video, I should say. Bye bye, take care.